Welcome back, everyone, to our weekly Market Insight broadcast. This is John Gatewood, founder and CEO of Gatewood Wealth Solutions, and our Chief Investment Officer, Aaron Tuttle. Welcome back, Aaron.
John, it's good to be here. I think you're headed down to Florida after this.
Yeah, I'm going to be running the Florida operations for the rest of the year, so Chris will be stepping into my place.
So by Florida operations, you mean your second home?
Yes, and all the clients that we have down there, since 20% of our business is down there.
So there's a lot of clients down there.
But it will be exciting to have Chris, because Chris does a great job, and he's on our investment committee here. But I saw that the Senate has passed the infrastructure bill, and now they're trying to get another $3.5 trillion pushed through.
At some point, we're talking about real money, right?
I think the only difference between the federal government and you and me is a few zeros. That's really all it is.
A few of them, that's for sure.
So you've been very passive this week in a lot of ways, but also active.
I guess it all depends on who you're out talking to.
So that leads us into our discussion.
Yes.
We're active versus passive investing. And I think that you came up with some great materials this week that we're going to educate our clients on, because that is a question that we get from time to time. Should we do passive investing? Should we do active investing? What does that really mean anyway?
Right, what does it mean? There's a lot there. So let me just kind of explain this chart. One, it's something I came across whenever I was doing my normal daily reviews, and I thought this was a great visual and a great presentation that was put together to try to explain the active versus passive, or at least the broad statement whenever people say that.
Well, let's get right into it.
So let's jump right into it. So we're looking at 5-year rolling averages, and the earliest date on this graph is March 2017. So it's looking from March 2012 to March 2017 to find out how well the funds have done. And if you're in the dark green bar, you're in the top quartile, or the top 25% of the funds in that rolling time period. And then if you're in the red bar, you're in the bottom 25%, or the bottom quartile, meaning that they were the poorest performing funds. And then obviously the light green is the second quartile, and the orange is the third quartile. And then we have that diamond. And that diamond represents where the benchmark ended up over that time frame. And if we look at this, we can see that the benchmark typically ends up in the second quartile, meaning that it's never in the top quartile. So there are funds that are doing better than the benchmark. But the benchmark is just slightly above average, meaning that the average fund is underperforming the benchmark. And,
I think that's the argument that people use. Well, look, see how difficult it is to beat the the passive benchmark. Why would we even try to do that?
It is difficult, and what this demonstrates is if we were to average this out, I can promise you that the difference between the benchmark and the average fund would be pretty much the fees, right?
Yeah.
So one thing is to always look for low-cost options, because the lower the management fee, then the closer you would be to the benchmark on a consistent basis. It first speaks to that idea. Well, one, are you trying to buy average funds?
Well, I don't like being average. I do like to be better than average.
But then the question is, well, can you consistently do it?
That's the question.
That is a question. And I do think going back to that low cost is a great way to give you an advantage of trying to find funds that are going to have more likeliness of beating the index. Because if you notice, there's always a top quartile in each year. So then the other thing is like, well, what do we mean by active versus passive?
Yeah, what do we mean? People say, I'm in a passive strategy, but everybody has a different passive strategy, so how can that be passive?
If you mean you're not really doing much, then that makes a lot of sense. But what typically is meant by a passive strategy is that you have no opinion on different markets, that it all is going to average out over time, and the time and the cost of underwriting that is going to be, it's not going to bear any fruit.
So it's kind of a set it and forget it type of strategy.
It is a set it and forget it type of strategy. And if you're getting market exposure, at the end of the day, it's going to work.
So you'll at least get the market minus whatever the fees are.
Right. So
but even then, you could maybe not get the best performance even in a passive strategy, because it depends on what you're actually buying in an asset class.
So what are you buying? If you're buying the S&P 500, about 25% of your holdings are going to be in just a handful of stocks. It's going to be dominated by Apple, Microsoft, Google, and some of the other big names. that may or may not be the concentration that you want. Remember, you're a passive approach. You're not doing anything. Also, is it truly a passive no opinion? Because a lot of people say, well, just buy the S&P 500. Well, if you're a truly passive strategy, you should have a market weighted, meaning that what is percentage of Apple versus all the other possible investments out there. So you would have a very small position in Apple, and you would have small positions in all the emerging markets, in the international markets. You would have small positions in all the available commodities and precious metals. You would have small percentages in private equity and venture capital and bonds. No one truly is actually a passive investor.
Right. Even if you're just in the S&P 500 and 25% of those are in these few technology stocks, as we've talked about before, if we have a rising rate environment, that could actually cause those stocks to way underperform the others in the S&P.
Right. So since no one's really taken a passive approach, because if you're buying the S&P 500, you're saying, well, I believe these U.S. large capitalized companies are my best investment option, and why would I buy anything else? That means you have an opinion.
Yes.
And you are taking an active tilt. So I don't think anyone actually can achieve passive. But that doesn't mean that taking a passive approach, meaning that you're not going to pay for the underwriting and the due diligence, is the wrong thing if the markets are reasonably efficient. But then you get to the paradox of passive investing, which is the assumption is that the market is efficient, that stocks are rationally priced and are trading at a fair price given all the information known about them. Well, how does that happen? Active investors, they're out there trying to move the stock prices to a rational thing. So if everyone was to passively invest, then there would be a bonanza for active investors to do due diligence. So we think these things do go in cycles where there's a lot of active managers because there's a lot of excess return through underwriting and trying to understand what the business valuation is. And then they move them to more efficient prices, meaning there's less excess return, which means that there's only so many active managers that can support, and then you start to underperform the benchmark, and then you have a lot of capital that flows to passive strategies. And then all of a sudden there's a lot of movement in stock prices that are no longer rational or efficient. And then so we do believe this will just happen in cycles for active versus passive.
Well, and we also build it into our portfolios because we're going to have active managers in some parts of our portfolio at different times, or we may have passive strategies because we believe they're in that period where there is a better opportunity to at least maintain the market, because you don't have as much potential, perhaps, in those upsides.
Because of how we view the active versus passive debate, we're really agnostic. We will use ETFs if it has a specific basket of stocks that we want at a very low cost on the internal management fee versus a mutual fund. So we're just looking at it as what basket of stocks, whether it's in an ETF wrapper or it's in an active manager, which ones are working well, and that's what we're trying to move to. So that's our approach. And then the question is well, how effective could this be? And I think by looking at that March 2017 data, we can start to understand why we believe our strategy, despite what looks to be a very efficient market, is still a good approach to management. Knowing that everyone is doing truly active management. We all have some type of opinion because none of us are actually buying the true passive portfolio. So here is the relative performance of sectors. And that first column is the data from March 2017. So this is data looking back from 2012 to 2017. And we can see that the S&P 500 was actually a little bit below the average if we just do a count, where consumer services was leading, followed by healthcare and consumer discretionary. A lot of technology stocks are really in that service and that discretionary basket. Financial sector, technology, and then the equal weighted, meaning that you're not buying a 6% stake in Apple and a 0.01% stake in a Fortune 500 company that you don't even know the name of. You're going to buy an equal amount of that. So it helps remove some of that concentration risk if you don't want to take it. And then you have the growth ETF. We've talked about value versus growth. So the growth side is stocks that follow that growth pattern. Industrial sector, and even oddly, the ETF for the S&P 500 did better than the S&P 500 index that year by 1 basis point. I'm sure the fees were a little bit higher than that.
Probably.
And then we can see, well, what sectors didn't perform well? Consumer staples, that value side, utilities, materials, real estate, and energy. And then what we notice is if we look at the 3-year, the 5-year, and the 10-year, there's a lot of consistency in what was doing well in 2017 and what continued to do well going forward. So if you look back 3 years...
That also means that things that were doing poorly continue to do poorly over that 10-year period of time.
Absolutely. So what we have advocated in a technical analysis and using trends and relative strength is whatever is doing well for a reason and is likely to continue to do well until there's some type of narrative change. There's a reason that we really ran that out. So right now technology has significantly dominated the performance. Look at energy. If you've held it on a 10-year time frame, you're down on a compounded basis, compounded basis, 17%.
Well, think about the prior 10 years where commodities, energy were really high.
Right, and if you remember, what was the highest market capitalized company prior to 2008? ExxonMobil. Now it's Apple. And so if you were buying the S&P 500, your biggest allocation, if you were buying it in 2012, was to ExxonMobil most likely. It certainly was near the top at that point. So our point is that for the most part, the sectors that were doing well continue to do well. And if you over-allocated to those sectors, you would have been in the top quartile of those funds.
Right. So if I hear what you're saying is that because trends do tend to continue, and this is part of our whole momentum strategy, if we can be overweight to those sectors that are trending well and underweight those that are trending poorly, that we could have a potential to outperform the basic market index.
Yes, and then what we pay attention to are the funds that we're buying, ETFs or mutual funds. Do they tend to be lower cost? Because those do matter. And how is their overall performance over the long term? Do they seem to be fairly good at active management? And then the big driver is, are they performing well, meaning are they in the right sectors? Whenever they do studies, 75% of a stock's movement is really attributed to the factors, what industry it's in, what's its market cap size. Not so much about what the earnings. It does have an effect. It's still 25% of it. But if you can get those sectors correctly, we think that gives you a likelihood of being near that top quartile so that you're no longer in the average fund. Because all those funds that were in the bottom quartile, it's probably not that they were horrible managers. They were probably value funds or utility funds or sector funds that were out of favor. Not necessarily that the manager was that poor, because remember, the difference over the long term is just the management fees with the idea that the market is efficient. Well, then that means that they can't be losing on their purchases either because they're the right price for the stock. So how would they do that? Now, this all assumes, by the way, whenever you're buying an index, that you stay invested, right? The research is that whether a passive or an active approach, a lot of people will still try to move out of the market because it's risky, meaning that we just had a sell-off, or it's not risky, meaning that we're at all-time highs. And there's a contrarian effect.
So even if you're passively invested, don't just get out.
Yeah, if you're passively invested, truly be passive and just stay there. Because there's nothing wrong with that approach of just getting exposure to market factors. In the long term, they will average out.
Yeah, but the question always is, can I do better? And that's what our data shows, is that you can do better. Doesn't mean that it's not a guarantee, right?
Not guaranteed.
But having a consistent outperformance, as we've been able to do, I think that's really what's most important.
So the previous slide, we were looking at the S&P 500. Which I think you can make the case that is a pretty efficient asset class. Well, let's look at the Russell 2000. Now, it's no longer consistently in the second quartile. It's in the third quartile.
So the Russell 2000 is the bottom 2,000 stocks?
Right.
Of what? Of the large cap, of the small cap, of the...
Of all of it. So it tends to be a mid-cap, small-cap fund. So then there's the Russell 1000, which is the upper end of what is typically called a mid-cap stock, to a large cap. There's a quality component because if the prices are high, they'll be higher in market cap. So there's this quality filter in the 1000. That means that there's not a quality filter on the 2000. We will talk about when we see the Russell 2000 actually doing well compared to other indexes, we call it a dash for trash. Because there's a lot of stocks that are getting put into that index, that the only people that are willing to buy it are the passive investors. So one risk on the large cap funds, if you're a passive investor, is you have overconcentration to a few individual names. On the other side, whenever you're in the smaller cap companies, you end up being the only source of funding and who is accepting these shares, because the index says they just buy the 2,000 shares. They're not going to have any ability. So this is actually one of the reasons that we use the S&P 600, which has a quality factor, and we think it's a much more difficult small cap index to beat. It also is a small cap index, not a blend of mid cap and small cap. But we can see that the Russell 2000 actually underperforms the average fund manager in there. So this is a place that we think active management certainly can get value, but we also don't think this would be a truly fair comparison when you're making that active to passive debate, because there's something going on with the index that a lot of passive investors are absorbing, the GameStops, the AMCs, the other companies that, other than the Wall Street bets and some hedge funds that are battling out, there's really not much movement. At one point we saw that GameStop was the largest holding in the real estate or retail ETF. It was also a very large holding here in the Russell 2000. And really, is that what you want to buy? So have an understanding of how indexes are constructed if that's the approach you want to go, which is kind of getting away from the idea of you can just be passive and not know what you do. Right. So let's then move into emerging markets. And we can see it's similar to the Russell 2000, at least back in 2017. It was in the lower quartile. Now, one thing is the dispersion. And I'm going to bounce back to that Russell 2000 because I want to talk about the asymmetry, especially in the later years. You can see that the outperformance of the first quartile is significantly higher than the underperformance of the bottom quartile. Meaning that if you just took a diversified approach of buying 5 or 6 active small cap funds, the outperformance on the winners would probably more than compensate than the underperformance for the losers of a more diversified strategy.
So could we say that you're actually better positioned to have more outperformance, more alpha, by investing in active small cap funds?
Yes, especially if you increase the number so that you limited the possibility of buying the passive, and their underperformance was less than the outperformance of your winners.
Got it.
So on net, you should actually do a little bit better.
What about the emerging markets?
And in the emerging markets, we still see the same effect, but notice the distribution or the difference between the best performing and the worst performing is so great. Well, when we're looking at the S&P 500, the large cap U.S. companies are going to look a lot like other large cap U.S. companies. There's going to be dispersion. And even the small cap U.S. companies are going to look similar. We have large cap, mid cap, small cap in this index. In addition, we have it across all kinds of different countries.
Right, you got China, Russia, India, Africa, Venezuela.
So a Chinese tech stock, large capitalized tech stock may be doing really well, while a Russian small cap stock maybe not be doing so well. And
who's the hot one this year? Was it Argentina or Venezuela?
India is actually
India
is performing very, very well, along with some Latin American countries. Whenever we look at it, China has struggled, especially since a lot of their index is made up with state-owned companies, which is another thing that the active investor can do, that the passive will then buy state-run companies, which tend to be inefficient, tend to be overemphasizing politics and not so much profit, and they tend not to be good long-term holds.
So would a conclusion of this be that, especially in the emerging market, that you'd be better off being in an active strategy rather than just having a passive strategy, simply because of the fact that there is such a variance between what the active can do versus the passive?
I think you can make that argument out of this data. Now, it has been trending over the last couple of years to be moving up to be a little bit more efficient. That benchmark is starting to be up in that second quartile. But I think it's really important to understand what you're owning here and having a good understanding. So I do think that there's value. But I think there's a value in all the active approaches, and that passive, low-cost strategies that you set it and forget it and you truly do leave it alone also can achieve. So we're really talking about differences between the average fund and the benchmark of the average cost of the fund. So if you're looking for low-cost funds, I think you're going to do well. And then you'll never have the opportunity to outperform and be in that top quartile unless you're doing active management. On the flip side, you shouldn't be in that lower bottom. But here's an example where an index is consistently in the bottom quartile. So the Barclays aggregate is the normal index for fixed income. We use it in our fixed income benchmark. So when we're comparing our fixed income, we're comparing it to the U.S. aggregate. Now, it's a very good, solid benchmark. There are good reasons that people are doing it, but it has got a very much a quality bent, which we like in the S&P 600, and it's not bad in the ag, especially since these are supposed to help reduce risk in portfolios. But when you're comparing fund managers, you can see fund managers have consistently outperformed that benchmark, and it's because, well, they have the ability to add some high yield in a significant way. They can buy other alternatives like convertibles that are not necessarily in there. In addition, there are funds that will take on more private offerings because it's more expensive to try to get listed and into an ETF or an index than it would be for the fund manager to be able to loan. So then they can get a nice bump up in their coupon by doing the underwriting themselves.
So based upon this, the fixed income, the active management is significantly better on an average, right?
For performance.
For performance.
Not adjusting for a possible risk factor, but the other thing that an active manager can do, and I think this is where a lot of this is being generated, is known as riding the curve. Now, I won't get into the details of riding the curve, but it's basically you can sell your shorter dated paper that as it gets closer to maturity, its yield goes down, and continue to buy the later dated paper so you can keep your yield higher relative to an index, which is just going to let that paper mature and get the money. So they can ride the curve as well. So there's just some things that active managers can do that indexes don't do. Once again, it's not a bad approach. I'm not criticizing the index, and it's the most reasonable benchmark for a reason.
So I think that the important takeaway from all this is that when you're doing the passive investing, it's important to understand what is it that I'm actually holding. And based upon this data, it's showing that you're holding good performers and poor performers.
Yes.
And you're getting the average between those. But there's also a difference in the amount of the ability of active managers to outperform depending upon the asset class that they're in. It's a little harder in the large cap space, but it's easier in the emerging market or fixed income space. So with that in mind, I think that an investor should think, well, what should I actually look for? Should I look just to have a set it and forget it and have the good with the bad and just get the average? Or is there a better way? And that's what we're proposing, is that there is a better way.
Well, we believe in our approach, for sure. But what I would say is you have this active versus passive debate. And the title of this is Active or Passive or Sales Pitch. Because I think there's a sleight of hand that often is used in our industry about a passive approach and the assumption that you can't outperform the market in the long term. Well, we see that 25% of the companies are consistently in that top quartile, and we haven't come across a page yet where the benchmark is in that top quartile. So there are fund managers that are doing it. How well can you pick it? Well, that's difficult for sure. But that's typically what you're getting told is, well, look, we're just going to save you fees. And they point at the internal management of the ETF as low cost. We have ETFs in our strategy. We love that they're low cost. We think Vanguard's Bogle has done a great service to capital markets by figuring out how to make passive products that reduce fees for market exposure. All for it. But what often isn't pointed out is that their advisory fee, the fee that they charge on the assets to build out this asset allocation, are similar to the people that are trying to do active management and are held accountable to a benchmark trying to outperform. So one of the reasons that we do the Market Insight call is to talk about and report how we're doing. And I think we have a good track record. Certainly last year we significantly outperformed. And when we're doing our pure signal approach, we see outperformance there. But they're paying a passive manager to say, I can't do anything about this.
Right, so if
Just
the
set
market
it and
goes
forget
down,
it.
hey, that's just it. The
And it's-
market goes down.
From a business model, it's a great business model
You don't
because
have
you
to
don't have to
spend
put
much
any
money
money
on
into research.
Exactly.
But you're going to charge the same amount. So yeah, I would say that if you are going to find an active manager, look at their historical performance. Do they have a track record? Do they have an articulated process that helps dictate whether they've done well and likely to continue to do well because they're going to follow their process, and it's the process that is helping do that. And then if there's somebody who's a passive investor, they don't have the research costs that the others do, you should be asking for a lower advisory fee for those passive managers that are out there touting that, oh, look at all these low-cost fees, but it's all somebody else's haircut, not their own.
Right, so they're not making that active view of the portfolios every day.
But they're charging as if they're doing, and then whenever they underperform or you're not happy with their performance, they say, well, we can't beat the market. We take a passive approach. Well, then why are you paying the fees of other advisors that do take an active approach? I think there should be some type of discount there.
Yeah.
And what we feel that it ends up being is a really good sales pitch because there's a lot of media talking about low cost, low cost, low cost. We love low-cost ETFs. We love low-cost mutual funds. We think they all have a place, and that's a good approach. But if you're doing less work for the client, I think the client should be getting a haircut on your services as well. So then,
very informative.
Active versus passive are really just a sales pitch, and we think that all of them have merit, and passive can't work without active. When we get to themes, so we're kind of wrapping up here, really there's no change. We continue to watch technicals. We're still in earnings season, and the earnings reports are coming in. They're really strong. So what can drive the market higher? Continual positive hits on earnings. And we talked about some of the headlines that could hurt the market, one of which would be an infrastructure bill not getting passed. Well, it looks like that's
with Congress right now,
right,
so we'll see what Nancy Pelosi does.
So most likely that'll go through. I can't remember a time a politician was like, hey, let's not spend additional money, right? They figure out a way.
At the time of this recording, they're saying that she's going to try to block the passage of this until the $3.5 trillion is approved by the Senate. But we'll see. This is all politics. Right?
It is all politics, and the amount of debt that we've taken on, highly encouraged to block.
And we got and now we'll have the debt ceiling debate coming up soon too. We've gone through that before.
And now the scorched earth that's going to come from that. I would really like to get those paid vacations that many of the people end up getting, right?
Exactly.
So then markets continue to climb the wall of worry. We still have that price objective about 45.60. We could probably tweak that to 45.70, but really what's the difference?
Right.
And if we do have a correction, which last time we said we're certainly due for one.
We are.
We would see that as an opportunity to begin adding a little risk into the portfolios. We are considering taking a lot of the equity positions are getting above the band. So if you're in a 60-40, we like to give it some room while we favor equities so it could get up to a 70-30. Some accounts are starting to get a little bit higher than that. So we may actually trim some of that here over the next couple of weeks to bring them back within their threshold,
tolerance.
Yes, their tolerance. Then if we look at market barometer, we bounce back and forth each week. Last week was all large cap growth, and if we look at quarter to date, we can see that large cap growth has been working this quarter, so it's up 5%, where the small cap value on the other side of the square is down 4.88, so almost 10% difference in that performance. Looking at year to date, we now see large cap growth is doing better than large cap value, but we have a lot of mid cap, small cap, so it hasn't, the growth side in those areas hasn't caught up to this significant outperformance of mid and small cap value at the beginning of the year. Despite the quarter to date underperformance, they still had significant returns. So the growth side on both mid and small are still lagging, but we do see some promise there. But most of our trades have moved us up into that top right corner of the style grid.
Well, very good discussion about the active passive investing, and of course, as usual, we want to thank our listeners for tuning in today because we're trying to give you our data-driven view with economic theory and try to come to the truth about investments in the market and how we really feel about client portfolios, and so you can be better informed to make actionable decisions.
Yes.
So thanks again, Aaron, and I guess I'll be watching you from the south with our daily rain, because it usually rains about 3 o'clock in the afternoon every day down in Florida.
You want to borrow my seersucker?
I might need that. Well, we look forward to having you back next week. Thanks so much again for listening in. If you liked what you heard, please hit the like button, share it with your friends, and if you haven't subscribed, of course, we're always looking to find new subscribers and would love to have you alerted to our weekly broadcasts. Thanks again, and we'll see you next week.